Ladies and gentlemen, good day and welcome to the Q2 H1 earnings conference call of Camlin Fine Sciences Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then 0 on your touch-tone telephone. Please note that this conference is being recorded. I now hand the conference over to Mr. Sanjesh Jain from ICICI Securities. Thank you, and over to you, Mr. Jain.
Thanks, Rochelle. Good afternoon, everyone. Thank you for joining with us on Camlin Fine Sciences Limited Q2 H1 FY22 results conference call. We have Camlin Fine Sciences Management, Mr. Ashish Tandilkar, Chairman, Mr. Nirmal Momaya, Managing Director, and Mr. Santosh Parab, CFO. I would like to invite Mr. Ashish to initiate the proceeding with his opening remark, post which we will have a Q&A session. Over to you, Ashish, sir.
Thank you. Welcome, ladies and gentlemen, to our second quarter earnings con call. At the outset, let me apologize for the delay in the posting of the results. Our board meeting was extended beyond what we thought it would take, and then there were some technical issues in uploading. But once again, my apologies. We will try to be as clear in our explanations of the quarter, and we will, of course, answer all your questions to the best of your satisfaction. So I now, as our usual convention is, hand over for the brief to Santosh Parab, our CFO. And later on, questions and answers will be answered by Nirmal Momaya, Managing Director, as is our convention. So over to you, Santosh.
Thanks, Ashish. Good evening and welcome. Yes, I would also like to apologize because there is some delay in closing of the board meeting and then some technical issues. So for the benefit of the participants, I will just take you through the results in a cursory manner. Our consolidated turnover was 311 crores in quarter 2, which is around 5.9% lesser than it was in the earlier quarter. It was 330. Our operational EBITDA after adjusting foreign exchange has reduced from 45 crores to 27 crores, which is a 486 basis point reduction. And obviously the profit before tax and profit after tax has also got impacted because of lower EBITDA margins. As far as half-year consolidated results are concerned, we had a 13.6% year-on-year increase in the revenue from 562 crores last year to 642 crores this year. Our adjusted EBITDA margins were 96.8 crores in last half year, which are 73.3 crores in current year. The EBITDA percentage is 11.42% in this current half year. As far as standalone is concerned, our revenues reduced by 5.2%. They were 138 crores in this quarter as against 145 crores in the last quarter. And corresponding EBITDA was 3.9 crores in compared to 19.2 crores in the last quarter. As far as half year is concerned, on standalone, the revenues have increased by 6% from 267 crores to 283 crores. While the foreign exchange adjusted operational EBITDA was 30 crores last year, which was 23 crores this year, a 314 basis point reduction in the percentage EBITDA. As it can be seen from the numbers, the quarterly and half-yearly results are not up to the mark. But the current situation highlights our consistent stand that our business must be watched year-on-year basis rather than quarter-on-quarter. Obviously, the question will be asked that whether this negative quarterly trend will continue in the future. I will come to that a bit later. First, let me discuss the operational highlights of the quarter. Overall demand in all the segments of the company remained very strong as the COVID restrictions were progressively eased, which indeed is a good sign of the business of the company in the future. However, there was a drop of around 5.9%, as I said, in the consolidated turnover. The results were impacted by some one-time non-recurring events and also the current structural and economic situation globally. Turnover was generally impacted due to the following reasons. As you know, economies are battling with disruptions in the logistic and supply chain, where not only the throughputs which are impacted, but the availability of raw material is also impacted. Further, we faced certain technical issues in our Dahej ethanol plant during the months of July and August, when we were in the process of scaling up the production to 100% utilization. This put pressure on our internal availability of throughput, that is hydroquinone and catechol. This reduced throughput consequently impacted the production of our high volume, high margin products such as TBHQ, BHA, MEHQ, PDMB as compared to Q1. And this led to reduction in sale of around 25 crores. And obviously a gross margin also got impacted by around 12.5 crores. Of course, the reduction of these products effectively changed the overall product mix also, which put further pressure on the margin. Of course, there was a silver lining to this, as the ethanol unit, as you are aware, has achieved 100% capacity utilization in the month of September 21 and is likely to continue with this trend of high capacity utilization in the future. Further, this quarter also saw one-time expenditure of around 3.50 crore on some bank consortium charges in India, a one-time supplier settlement in Europe, and some trademark registration of some new blends during the quarter, among others. Now we come to the impacts on account of structural and economic situation prevailing in India as well as globally. As you are aware, world is staring at an unprecedented increase in logistic cost. Company, as you know, is not able to pass on to this cost immediately, as there is a lag of a quarter for the passing it on. Our company is working on a mitigation strategy here of changing the terms to FOB from October 21, the impact of which will be visible in the subsequent quarter. Further, as you are aware, the inflationary trend continues in crude, and that is impacting the raw material cost even in the current quarter. As you would have seen, there is also an increase in employee cost quarter on quarter. The main component of 101.8 crores was on account of yearly increments and induction of managing director, as well as new sales personnel and new business heads in the current quarter. Of course, the benefits of new inductees will start fructifying in the subsequent quarter. Lastly, even though the gross margins remain stable quarter on quarter, it remained shy of expected 50% plus margin, mainly due to the increase in selling prices, which we did as compared to last quarter, were entirely undone by the inflationary conditions and a lag of quarter to pass on to the customer of the continuous increase of prices in the current quarter. Of course, there are some advantage also there of opening of the country's corridor post the COVID relaxations, but that has also brought in some costs as physical travel and sale promotion have now restarted. Further, the volatility in foreign currencies, especially in Brazil, resulted in a foreign exchange loss of around 5 crores during the quarter. And consequently, the EBITDA was severely impacted and a reduction of 490 basis point happened. Now coming back to the question whether this negative adverse trend will continue. Now looking at the strengthening of global demand, our completion of stabilization of the ethanol unit and its reaching its maximum capacity, result of unwinding of ethanol cost advantage, then we are seeing robust growth also in segments of blends to continue and further increase in productivity. We are quite confident of achieving the yearly guidance on turnover. We are also confident of recouping the lost EBITDA margins. However, we will have to overcome the structural hurdles which are in the global markets, like of the continuing inflationary trend in raw material prices. And of course, you would have also heard about the impending power crisis around the globe and still prevailing supply chain bottlenecks. However, in a nutshell, this aberration in margin is unlikely to continue in the future. Now I come to quickly to the foreign operations of the group. Our Chinese vanillin subsidiary continues to be shut down owing to the Supreme Court order, which you are already aware of. The retrial application filed by our partner was heard in October 21. The verdict thereof is expected anytime this month. So we will be knowing the verdict, and then based on that verdict, we will be taking the further course of action. Our European Italy, which produces basically diphenols, continue to operate at full capacity and has posted a quarterly revenue of 111 crores. We have sold hydroquinone and some part of catechol in the open market from Europe. CFS Mexico also clocked healthy operating revenue of 76 crore, and both these subsidiaries will continue to grow in the future. South American markets were stable, where our subsidiary CFS Brazil posted a revenue of around 20 crores during this quarter. CFS North America, or US subsidiary, is also slowly but certainly emerging out of the severe COVID impact in US. It clocked a turnover of 12 crores in this quarter. I'll come to the CAPEX program which has been undertaken and is under construction. So our construction of ethyl vanillin plant at Dahej is progressing satisfactorily and would meet the expected target of commercial production in Q1 FY23. As you are aware, the company has completed the acquisition process of Algalar Nutrapharms by acquiring 80% stake yesterday, that is November 10, 2021. This foray in nutraceutical segment with exciting products such as omega-3 fatty acids, etc., will not only add to operational revenue, we scale up in next 2 years, but also contribute in improving the margins. All in all, the performance in the quarter is not a trend. We are more than likely to bounce back and achieve our target goals. Thank you very much, and now we will take your calls.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. To ask a question, please enter star then 1 on your touchtone telephone. If your questions are answered, you may withdraw your question from the queue by pressing star then 2. We will wait for a moment while the question queue assembles. Our first question is from the line of Rohit Sinha of Sunidhi Securities. Please go ahead.
Yeah, thank you for taking my question, sir. Am I audible?
Yes.
Yeah, thank you. So, I think everyone was expecting some margin impact because of the rising input cost for almost all companies what we have seen in last some time. But that is where I was looking at how our volumes have been there for this quarter. I mean, what kind of growth was there? Because 20% on the Concall side, if you look at the top line growth, I think that kind of pricing environment is already there. That most of the prices are higher. So how much we have passed on the pricing increase, and I think what kind of volume growth was there? Because for last 3 quarters, I think we are in a similar trajectory of 310-20 crore. So how we should see that thing going ahead?
Yeah. So, Rohit, to answer your question, as Santosh had explained earlier, that we lost some volume because of supply chain and the diphenol scale-up. So basically, raw material hydroquinone was short for us in this quarter as compared to Q1, and that led to erosion of sales. What we would have achieved if we had achieved the same volume as Q1, our sales would have been higher by almost about 25 to 30 crores. But the price increase that we did effect brought this difference down by to about 10 crores or so. So we've been able to pass on the price increases, the cost increases of the previous quarter. However, certain raw materials have also gone up during this quarter, which the passing on of that cost increases will happen in the current quarter, which is the ongoing quarter.
Okay. And just to think about this, the Dahej impact. Could you just help us understand what was the issue, or why this kind of impact was there? And because that is the main thing which everyone is talking about for some time, and this has mainly impacted our standalone business in this quarter. Margins have completely shrunk to single digit %. So how we have overcome it 100%, completely, or it's still
No. So we completely overcome that, and we are running at 100% capacity from September. It was only in July, August to scale it up to 100%. We had to make some technical changes, and some equipment had to be modified, which got done, and that is the reason why the production had slowed down during those 2 months. But now we are running at 100% in September, as well as in October we ran at 100%, and we continue to run in November at 100%.
Okay, that's good. That's good. So just if the Dahej was some issue, wasn't it was possible for us to source it from our Italy plant and sort of that raw material availability here?
No, so raw material basically from Italy, which we normally would, in the past we were importing, we were selling, and we had already pre-contracted to sell it in the European market. So there was no way to bring material, and this issue was not an anticipated issue. This was an ongoing modification that we had to do, and which there were certain problems that happened during that time, which we needed to fix to get to the 100%. That is the reason why, keeping the supply chain in mind, this was a problem.
Okay. That's it from my side. I'll come back in queue. Thank you.
Thank you very much. Before we take the next question, we'd like to remind participants that you may enter *1 to ask a question. Our next question is from the line of Surya Patra from Phillip Capital. Please go ahead.
Hello. Yeah, thank you for this opportunity, sir. Just a couple of questions. First question is on the margin itself. So, obviously, you have mentioned about few reasons that has impacted our overall margin as well as the gross margin. So, before coming to that point, if you can just give an indication about the product mixer in terms of like the blends and all that, performance chemical, and so that will be the kind of indicator, and subsequently I'll have questions on the.
Okay, so the breakup is our straights business, which is the antioxidant straights business. In the first quarter was 79. One moment. Was 79.7 crores, which has come down to 73.47. Performance chemicals from 145 came down to 131. Blends increased from 81 to 84. Aroma is whatever residual stock we had was disposed of, and nutraceuticals remain constant, and others remain constant at about 17 crores. So that's the breakup of 329 of last quarter versus this quarter of 310. So the ones which were impacted were high value and high margin businesses, which is our TBHQ, BHA, MEHQ, and PDMB.
Okay. And that was because of the stocking of the last year that you mentioned, or what was the reason, sir?
No, the reason was that we did not have enough hydroquinone as compared to the first quarter. The reason for that shortage of hydroquinone, basic raw material to make these 4 products, which are really the high margin products for us, was that the supply of hydroquinone was coming from Dahej for our Tarapur unit, and Dahej in the months of July and more in August had, like we said, we were making some modifications to scale up, which scale up, of course, we have demonstrated in September. So there was a shortage of hydroquinone during this period, which led to an erosion. I mean, what we would have added at least 25 to 30 crores if we had followed even Q1, not even at 100%, but even at a lower capacity.
Okay, so that means was it means considering the kind of trade issues what the world over that was witnessed about availability container and all that, whether that was a conscious plan that we had to focus more on the or depend more on the Dahej plant so that we reduced.
Yeah, absolutely. Because looking at the way supply chain issues one is facing in all raw materials which we are importing, we are trying to localize as much as possible what we can do. And of course, Dahej was one of the reasons why we set up Dahej was also to have a captive and a material available in India. And it's essentially our strategy has been that the product that we make in Italy, we are now selling in the market in Europe, and what we make in Dahej, we are consuming ourselves. Still, of course, as we require more and more hydroquinone as we go along, as new products get scaled up, of course, we will bring in material from even Italy to India.
Okay. So, what was the average utilization, sir? Although in the last month, for the quarter, we have said 100% utilization. So, at 100% utilization, that would have met our entire hydroquinone requirement. But obviously, the average utilization would be much lower. So, can you tell that?
Yeah. So the average capacity utilization was close to about 70 odd %.
Okay.
And at 100%, we get actually all our current requirements are taken care of.
Okay. So that means at least this availability of hydroquinone and or the what has impacted the performance, that would not be there at least next quarter or running quarter, that I would say.
That's right. So in the current quarter, we have adequate hydroquinone available to us from Dahej for all our downstream products.
Okay. And so whether that is because of the kind of impact on the margins or trade challenges, whatever that we have witnessed in the current quarter or current time frame that we are witnessing, will that impact the new businesses, what we had indicated that was supposed to start from the third quarter, like this Algal or Algalar or the MEH2 or even the calcium propionate?
No. So basically, all the new businesses that we are starting now will not get impacted because of raw materials. And even the Algalar acquisition that we completed now, so we are in charge from today, and we're working on trying to scale that up as well. MEHQ as well we've started scaling up our MEHQ production with adequate hydroquinone available from Dahej. You see a growth in our performance chemicals business as well.
Okay. Okay. So just last one question, sir. In terms of the China plant, you mentioned obviously that there is a kind of update likely from the regulatory or the litigation that is going on. But whether we have decided about the new product that we are thinking of introducing there, or we want to continue with the kind of vanilla business there itself?
No. So we are more inclined to start the new product because our vanillin facility is now almost getting finished in Dahej. So what we are trying to see is if we can make the new product there, for which we're making some environmental applications in the next month. And we hope to get the response and get the approvals in the next maybe 3 to 4 months, and then start that other product.
Sure, sir. I'll have a couple more questions. I'll join in the queue.
Sure.
Thank you very much. Our next question is from the line of Ankur Periwal from Axis Capital. Please go ahead.
Yeah, hi, sir. Thank you for the opportunity. My first question is on the margin front again. If I look at the standalone side and given the reasons which you highlighted in terms of pressure from raw material, coal cost, logistics, etc., visible in terms of margins declining on a quarter-on-quarter basis. But on a year-on-year basis, I think that was a low base effect which was impacting standalone. On the Concall side, the margins are still sort of holding on. I'm referring more on the gross margins front on a quarter-on-quarter basis. So anything specific happening in the international market, wherein, the margins are better on console?
Yeah. So the margins are better on console purely because hydroquinone, which was manufactured in Italy and sold in Europe, the prices of hydroquinone were high, and that's the reason why we got a better margins in Europe. That is the major contributing factor.
Okay, sure. And these, the selling of this HQ in the international and European market, is this on a, what sort of duration is this? Is this a short-term contract, spot contracts, or these are longer-term contractual things that we enter into?
Currently, nobody's signing any long-term contracts because with the volatility which is there in raw material prices and supply of, especially in Europe now, with the gas prices in Italy and electricity costs going up considerably, it's very difficult to sign any long-term contracts. So essentially, what we are doing is we are selling. Of course, it's customers who we build relationships with, but we are not signing any long-term contracts because raw material availability prices. It's too much of a risk at this point of time.
Sure. So these will be largely spot contracts or probably a 2-month, 3-month or a 6-month contractual there?
So typically we pre-book for 3 to 6 months. So we are booked till now. Right now, currently we are booked till February, and then every 3 months we keep rolling that for a quarterly booking.
And just for my understanding, the pricing here, the contracts which we have till February, the pricing will be what will happen as of, let's say, next month, or these prices are also frozen?
No, prices are frozen. That's why we take only quarterly. We don't take more than 3 months out.
Sure. So the benefit of this prices, international prices being higher, will continue in next quarter as well, and maybe partly in Q4 also.
Yes. Right now it looks like that.
Sure. That's helpful. Second question on the Dahej operations. You mentioned now we are operating at 100%, and given that the capacity at Dahej and Italy is largely similar, going ahead, this should incrementally add to our overall profitability even on the standalone side. Will that be a fair assumption?
That is right. Absolutely correct.
Great. Sir, related question to that. Now, you did mention the initiatives that we are taking in terms of price hikes. If you can share what price hike have we taken, across the product, broad range probably will be useful in the month in Q2, if at all, or otherwise starting Q3.
In Q2, it would have been about we've taken about close to 10% price rise, and in the current quarter also we've further increased the prices because some of the raw material prices went up in Q2. Again, the price rise and pass-through is for hydroquinone and its derivatives. For catechol, that it's not so easy to pass on all the price hikes. So there we've not been able to get those kind of price hikes. We've probably got 2-3%.
Okay. So HQ and derivatives, 10% hike in Q2 and further maybe 5-7%?
Further 10%, right, in
further 10% this quarter.
Yeah.
Great. And sir, lastly, if I may, your comments on the capex plans as well as on the debt reduction side. In this quarter, I am seeing there is an increase in net debt. But if you can share some thoughts there, both on capex as well as debt side. Thanks.
Yeah. So on the capex, we have our ethyl vanillin plant, which is progressing, which is under construction, progressing well. It's about 150 crore investment, which is planned there, and we have completed about 65% of the project till date, and it's on track for completion by April.
Okay. And any other capex apart from this?
Currently, no major capex at this point of time. This is the major one. We have some small capexes, but those are not really significant.
Sure. And sir, lastly, on the debt side, if you can comment, how are we looking at that side?
Yeah. So the debt, our gross debt has actually come down in the last 6 months from March, from 537 crores to 512 crores. Net debt, of course, has gone up slightly because we've started the capex cycle, and we've invested almost 80-90 crores in the vanillin facility in the last 6 months.
Sure. So my question more was like, probably by the end of this year or maybe by FY23, any targets there in terms of net debt reduction and where this 4.2 billion odd net can go?
So basically, I mean, we are reducing our debt as it comes due on the long-term borrowings. As far as total debt, we have a FCCB which will probably get converted very soon from IFC, which will of course reduce the debt by approximately 110 crores. So we probably be at about 500 crore debt after even our vanillin investment.
Okay, that's helpful, sir. Thank you and all the best.
Thank you very much. Our next question is from the line, a follow-up from the line of Rohit Sinha from Sunidhi Securities. Please go ahead. Mr. Sinha? Can you unmute your line, please? As there is no response, we will move on.
Yeah, sorry. So, sir, just if you could overall tell what was the overall exceptional item for this quarter, which has basically impacted our numbers at the EBITDA level. I mean, the exceptional item for this quarter on the total basis.
Sorry, I didn't follow your question.
Rohit, can you speak a bit louder because we are not able to hear you.
It's not clear. Your voice was distorted.
Hello, am I audible now?
Yeah.
Yeah. So just wanted to know overall what was the amount for this quarter, which is basically one-time item for us.
Yeah. So what is non-recurring, and that's what Santosh said in his opening statement was. So that's 12.5, roughly 12.5 crores was on the loss of margin because of no availability of raw material. Then there were some non-recurring one-time expenses of 3.5 crores. And of course the foreign exchange loss, which is again non-recurring of 5 crores.
Okay. So overall, I mean, in 22 crore kind of figure is there, which has okay.
Yeah.
Okay. Yeah. That's it from my side. Thank you.
Thank you very much. Our next question is from the line of Anish Jobalia of Banyan Capital Advisors. Please go ahead.
Yeah, hi. Good evening to the team, and thank you for the opportunity. I just want to check in terms of our guidance of achieving more than 40-50 crores of sales. So how is this looking like given some subdued quarter? So is there any change around that? Would be helpful to know. And also in terms of the margins, we were expecting to probably not recoup the entire gross margins which we did in FY21, but we were still looking at expanding the gross margins and also an operating leverage on our other expenses. So now, given the situation explained by Santosh, so how do we think about the margin expansion possibilities in this year? Would be helpful to know, sir. Thank you.
So basically, sorry, can you start your question first? The first part of your question, I lost.
Yeah, so my first part of the question is, we are looking at minimum 14-50 crores of sales in the last quarter, in Q1 itself, for the full year. So now, is there any change in the thinking about being able to achieve that numbers? Would be helpful to know what are your, penciled out thoughts around this.
Yeah, so achieving the turnover we are on target for. Question on margins, what the margins evolution will be. While gross margins have remained constant between these two first and the second third, we are obviously working towards improving the gross margins and with a higher turnover also leveraging on overheads being spread over a larger turnover. So improving the margins is what is expected in the next 2 quarters.
So, but what would be the extent of that improvement given that, we were, last year we did 15% and because of days we are going to reach close to 18% or so. because of the operating leverage?
It's very difficult to answer that question at this point of time because as you understand, the raw material prices are not under our control at this point of time, and there's a lot of volatility, and you see it across the board for I would say at least 90% of the chemicals that we deal in. There's tremendous amount of volatility. So really difficult to give you a number on what that margin will be, but it will surely improve from where we were in the first 2 quarters.
Okay, fine. Thank you very much for the subsequent.
Okay, thanks.
Thank you. Our next question is from the line of Prajal from ICICI. Please go ahead.
Yeah, thanks for giving me an opportunity. I just wanted to ask all this, if we quantify the Q2 loss, then what is due to the delay in the price implementation and what is due to the other factors? And is this loss are one-off in nature or we will see some margin pressure in the next coming quarters?
So this is one time. We've been able to pass on the price increase for what we had in Q1, the raw material prices that went up in Q1. We were able to pass it on in Q2. Again, raw material prices have gone up in Q2, which we are passing on in the Q3. So we don't expect that as an impact that continues to be a problem. As far as what impacted Q2 was more a one-time incident than really something which is going to be ongoing because with raw material availability and our plant running at 100% capacity, it evens out all the supply chain issues that we had in this quarter.
Okay, so this will be the one-off impact only, and from next quarter onward, we will be passing the full price increase also, and there will be no such kind of continuous incurring any kind of cost and all, right?
Yes, that's the expectation. Yeah.
Okay, thanks a lot.
Thank you. Our next question is from the line of Ravi Mehta of Deep Financial. Please go ahead.
Yeah, hi. Thanks for the opportunity. So when we just adjust the one-offs, also the Dahej impact, if we adjust that, then probably your top line could be similar on a quarter-on-quarter basis, but your margins could be hitting those 20% mark. Just a fair understanding. Is that the track on which we would be going ahead? I'm not asking for an explicit guidance, but is that the way coming quarters can be?
Yes, that's true. The expectation is that we will utilize 100% of the capacity and we will utilize all that hydroquinone that comes from Dahej for expanding our value-added product and volumes. The market demand is very strong. Question is how much can we produce and supply to the market?
Sure. And also, this quarter is also, halfway. So how are the raw material prices? Because we saw that, the pass on is happening with a lag.
Yeah.
So are you seeing still pressure in this, half of the quarter that has gone by, and can there be, further snowballing of passing on in the next quarter and a similar pressure going ahead?
So what we've done is, yes, we saw that raw material prices were going up in end of September and October. Some of the basic materials like and dimethyl sulfate and methanol and everywhere you see there's been substantial increase in raw material cost. Phenol also has gone up slightly. So in anticipation, we did do some correction at the beginning of this quarter. However, there will be some lag again. But so the idea was that we should get to a 50% gross margin. I'm hoping that we'll be in between where we are and 50% in this quarter, and then hopefully in the next quarter we try and reach that 50% mark.
Sure. Good luck. Yeah. Thanks.
Thank you.
Thank you. Our next question is a follow-up from the line of Surya Patra from Phillip Capital. Please go ahead.
Yeah. One question on the freight cost. See, we have this quarter that okay, we should be avoiding import of things from Italy because freight was one of the key cost component, concerning cost component. So in the subsequent quarter, if things will resume, then what is the share of this freight cost in the overall RM cost, whether it is influential one?
So RM and sales, it's both. So freight costs, in RM we typically buy CIF. So of course, our suppliers, of course, increase some of the price increases due to freight, but we don't get a breakup as to how much is really a reason due to freight. But certainly, freight costs have increased considerably. In some geographies, have gone up by 4 and 5 times. So as far as our sales go, we are trying to move our business to as much as we can on FOB because it's very difficult to, if you've got a booking today for a supply in January, and if it's CIF and if the prices go up, there's nothing you can do. So we're trying to move very quickly to an FOB kind of situation so that at least whatever the freight is borne by the customer.
Okay, that is a system that has been implemented and it is accepted generally.
Yeah, it is being accepted. Yeah, I mean, I would say most customers will move to that. Of course, some may not, but our expectation is at least 70-80% of our business should move to FOB. Of course, we also have a lot of intercompany transfers and we move material around. I mean, that of course is a cost that we have to bear in that sense. Yes. And ultimately in the final product, which is then a blend which is sold, we need to pass that on to the ultimate consumer.
Okay. And another question on the cost against this. See, in fact, whether we are facing any of the cost challenge because of the kind of a catechol that we would be producing larger than our requirement at this current juncture.
Yes. So that's true. And we will have some stock pile up that we are planning purely because of our vanillin facility coming on stream. In April, we will require catechol. So what we are trying to do is, balance out to have some security and some stock of catechol, ready for our vanillin plant.
And that would be largely sufficient from our Dahej plant.
Only Dahej, yes. Yes, Dahej. So from China, from Italy, we have pre-sold all the catechol.
Okay. So then, compared to last quarter, the swinging cost factors, if we consider going ahead for, let's say, Q3 and Q4, this phenol is not a kind of driving or is not seeing any kind of variation, I think, or it should be.
No, it has gone up slightly. Phenol has gone up slightly in this quarter as compared to last. Yeah, okay. Slightly. Not much, but I don't think it's. See, because in Europe, we are seeing that the prices are stabilizing and they're on their way down for phenol. So, my expectation is by maybe end of this quarter, it should again ease off.
Okay. And as of now, whether the TBHQ, BHA, these are the products are still an important contributor to our margin, overall consolidated margin, because the blend side, it has not deviated from the trend. But it is just that, okay, TBHQ, BHA, that supported.
So TBHQ, BHA, MEHQ, and PDMB, these are 4 hydroquinone-based products, which are the real margin drivers.
Okay. So we should see a kind of meaningful kind of incremental business from MEHQ next quarter, sir. Is that so?
Yeah. So the idea is that we will certainly scale up the MEHQ in this quarter, in the next quarter. As hydroquinone, so first priority we give is to TBHQ, BHA.
Of course. Yes.
And we've expanded some capacity there also so that we can service the market effectively from there. And then the next is MEHQ, and PDMB, of course, is a joint product along with MEHQ. So both those is next in queue, and so the focus is going to be really to scale up all of these. Yeah.
Okay. This last question, sir, about this vanilla new project, whether that is all on track to commission before March, sir?
Yes. So we are expecting it to be ready for commercial production in the first quarter. Yeah.
Okay. Sure, sir. Okay.
Of course, right now, of course, the prices of vanillin have gone through the roof. I mean, if you look at stats, it's like $30, $35. I mean, it's absolutely unheard of kind of prices. So in that sense, it's a good point of entry for us because a new supplier in this environment is more than welcome because prices then start easing off with a new supplier.
So that means the biggest margin swinging factor for next year, if you consider, then it seems vanilla, followed by the Dahej utilization.
Yes, that's right.
Hopefully, something can come from the China side, given some positive news flow.
Right. That's right.
Okay. Thank you, sir.
Thank you. Our next question is from the line of Timant Shah from One Up Finance. Please go ahead.
Yeah, thank you for the opportunity. Two or three quick questions. Any raw material headwinds in the overseas facility in particular?
So not really. I mean, phenol prices have remained pretty stable. Actually, they're on the way down in Europe, which is one of our main raw materials. But the headwind in Europe has been the gas prices, because gas prices went up considerably in the last 3 months. But now we are seeing that the Russian gas has started flowing into Europe now, and the prices are easing off. And our expectation is that by Jan-Feb, it should, kind of go back to the levels where they were. I mean, of course, it'll never be the same, but, more reasonable levels.
Secondly, most of our contracts, predominantly, do they have a pass-through mechanism with a lag of a quarter, or how does it work?
No, so we don't have any long-term contracts, very limited small businesses, long-term contract business. And the others are all quarterly contracts or maybe 6 months. So which, if it's a quarterly contract, it typically means that the next quarter, there's a lag of a quarter.
Sorry, I couldn't quite catch that, please.
So
out of every 100 rupee that you sell, how much is 3 monthly, how much is 6 monthly, and how much
I would say 90% is 3 monthly, and 10% would be either 6 monthly or annual.
So does it connote that 90% of the gross margin capture would happen in the next quarter?
Yes, for all the products there, where, like I mentioned earlier in the call, for hydroquinone and hydroquinone-based products, the pass-through happens with a lag of 1 quarter. With catechol, the pass-through is not, we can't pass through the entire cost increase because of it being in an oversupply situation. So there, of course, the pass-through is slightly lower. But yes, whatever happens does happen in the next quarter.
Which chain of catechol is in oversupply? Is it the glycol or
No, catechol. Catechol itself is in oversupply. So then everything below that starts becoming, not oversupply situation, but your competitors also get a cheap source of catechol from our competitors, for catechol. So Solvay makes catechol, but Solvay doesn't increase the price. We can pass on. If they increase it, we can pass on. So it's really a game of market share versus price, passing on prices.
And lastly, which is the chain where you can have tremendous pricing power, and which is the chain where you have zero pricing power?
That's what. So in hydroquinone and its derivatives, we have a pricing power where we can pass on the kind of increases. In catechol, it is limited. And of course, now with vanillin coming up in vanillin, that remains, that we can pass on.
Okay, so in the catechol category, right now we are bereft of vanillin. We are doing glycol and
Veratrol, glycol, and TBC. Yeah, three products.
I see. Okay. And lastly, you alluded to you reaching a certain amount of turnover, and with this kind of pass through, can you be upping that target, or would you still want to maintain that target, or how does it work?
Yeah, so I think this target is what I think is achievable. Of course, if the prices go up, 5, 7, 10% in the next quarter, maybe, we'll beat the target. But at this point of time, I'd say yes, this target is very achievable.
So, given a 4-5% drop in gross margins, would you want to kind of revise that 1400 to 1500 based on same percentages, given the pass-through pending?
No. So I would say that since we lost about 30-40 crores here in this quarter, we make up that, and of course we will do more than make up that. I would yet say it will be in the range of 14 to 1500 crores.
Great. And sorry for insisting on one more question. With the logistics kind of slowly easing out, would you say a fair bit would be coming back in terms of overall cost and margins? So you just alluded to that this corresponding sale would have a certain kind of gross margin trajectory and the corresponding EBITDA margin. So how would you want to take it for the next year, given a slight ease in most of the, be it raw material and be it logistics, which have been the pain point?
So logistics, I don't know whether in the next year there be any. There's no sight of relief. In raw materials also, what we see is that at least in this quarter also we see many raw materials where prices have gone up, and so it's very difficult to predict that. It's really beyond us to be able to give any guidance on that.
No, meaning at some stage you will have to kind of at least have a proper pass-through mechanism, if nothing else.
So we have a pass-through mechanism for, like I mentioned earlier, for hydroquinone and its derivatives. For catechol we don't have.
Sure.
In catechol for vanillin we will have. So that's. I mean, I can't answer any further than that. Yeah. So.
Right.
Yeah.
Great. And would you want to also comment on, lastly, on the working capital cycle? How would you see that on an consolidated basis?
So we have been able to, even with reduced cash flows in this quarter, we have been able to control the credit working capital cycle and the working capital itself. But looking at the logistic problems, I think the working capital cycle is going to remain in the range of around 100 days till the logistics and every bottlenecks are released. So we don't foresee much of working capital cycle reduction by the end of this year. It is going to remain at 100 days.
Yeah. Many thanks for answering all the questions. Thank you.
Thank you. Our last question is from the line of Dhruv Shah from Ambika Fincap. Please go ahead.
Yeah, hi. Thank you for the opportunity. Firstly, I want to ask on the Mexico subsidiary, when are we due to close the deal?
Next week.
Oh, okay. Next week.
Yeah.
And
Monday.
my next question is on Lockheed Martin. Have we made any progress? Because what I understand is we were due to send at least samples by next year. So have we made any progress on that part?
Yeah. So basically, it's an work in progress, project in process. In fact, after the pandemic, it's the first time that we've got a whole team of their people down here, the technical team, for taking some production lots, because they're changing some raw materials and some processes to reduce cost. So it's progressing well, and we have to supply them 600 tons of material in 2023, by December of 2023, and so we are on track for that. Yeah.
But they have not given any indications, or so we haven't received any feedback. It's still work in progress.
Yeah, it's in work in progress. I mean, the first commercial order we've got for 600 tons, which we have to supply, and which of course, which is 2 years out, but we have to produce that within the facilities that we have, and then of course by end of 23 we will have to set up the next what we call the pilot plant or the small plant by December of 23, for which the design engineering work is going on.
Okay, great, and all the best for future quarters. Thank you.
Thank you. So we have one more question from Shivaji Mehta from an individual investor. Please go ahead.
Hello, am I audible?
Yes, you are.
Thank you for this opportunity. I just had a question on the catechol bit, wherein you mentioned there is the supply issue. So just trying to understand, by when can this situation ease out? Do we have any clarity on that?
Sorry, I didn't follow your question.
So you had mentioned there's an oversupply in the catechol market, in the catechol industry. So just trying to understand, is this situation going to last for a long time, or do you feel that at some point this oversupply could ease out with the demand really catching up?
Yes. So there are many. It's a good question. Of course, value-added product vanillin is what for us at least the oversupply situation which we are facing will ease off considerably, because we are setting up a vanillin facility which will consume almost everything that we make in Dahej. And we, of course, have other downstream products where we consume also some substantial amount of catechol. So even from Italy, what we produce, we'll be able to consume all of it with value-added products. So yeah, it's in the next financial year, this oversupply position will get corrected, and the margins will improve from the catechol chain.
Sure, thanks. And also, I think, so on the capex bit, so the last capex will come up, as you said, in next year by April. So are we going to embark on another phase of capex? Any sort of clarity you could give on that?
So right now, we have some small projects in hand which we'll be taking up, but there's nothing as of now, as we speak, there is nothing of a very material or substantial investment.
So is it fair to say next year you'd just probably try to stabilize the existing capex before we really embark on the next phase of growth?
Yes, that's right. And we, like I said, we do have some small projects, but those are not very they're not substantially large.
Right. And lastly, on the Lockheed Martin, you mentioned that there's this 600 tons that you need to supply by FY23. So in value terms, what would that be?
It's not FY23, it's in FY24, December of 23. In value terms, I mean, it's competitive. I don't want to disclose that because I have a NDA with them.
Sure.
So I can't really, without their approval, I can't disclose pricing.
Sure. Thanks a lot, sir. I'm wishing you all the best.
Thank you very much.
Thank you very much. As there are no further questions, I would like to thank the management team for the presentation and the Q&A. Ladies and gentlemen, on behalf of the management of Camlin Fine Sciences and ICICI Securities, that concludes this conference call. Thank you for joining us, and you may now disconnect your lines.
Thank you very much.
Thank you.
Thank you.
Thank you.